Hello everyone, it's me Biman Farooq. Welcome to Law of Money. Today we are going to learn about reports, documents, and ratios. So let's start. Financial statement analysis and ratios. Good morning everyone and welcome to this comprehensive section on financial statement analysis and ratios. Corporate financial statement can look like a wall of confusing numbers at first glance. However, once you learn the language of ratios, these documents tell a clear story about business health. Today we are going to learn how to break down the statements to truly understand four core dimensions of any company. It is operational performance, it is short-term liquidity, its long-term solvency, and its ultimate profitability. To identify hidden risks, judges management's competence, and spot genuine corporate wealth creation engines. Let's get started. Introduction. Let's establish our baseline definition. Financial statement analysis is a structured process of evaluating company's financial performance and position by systematically examining its financial statements. It is the tool that transforms raw bookkeeping ledger data into actionable high-level business intelligence, helping stakeholders, whether they're institutional equity investors, banks, extending credit lines, or internal management teams. When we look at financial analysis, we visualize it as repeating dynamic cycles supported by three main pillars: performance, liquidity, and solvency. We rely on three core interconnected financial statements: the balance sheet, the income statement, and the cash flow statement. Financial statement overview. To conduct a great analysis, you must know exactly what each reporting tool is designed to do. Let's look at this overview table to break down the big three statements. First, the balance sheet. Its purpose is to show the exact financial position of a company at a specific point in time. It's frozen snapshot, a photograph taken at midnight on the last day of the financial year. The key item you will evaluate here are assets, liability, and stakeholder equity, bound tightly by the accounting identity that assets must equal your combined liability and equity. Second, the income statement or P&L. Unlike the snapshot nature of the balance sheet, this statement shows the company's professional performance over a specific period of time, like a constitution movie tracking a dynamic timeline, employee bills and interest expenses to finally reach the net profit bottom line. Third, the cash flow statement. This bridges the critical gap between accounting metrics and actual hard cash, showing real cash inflows and outflows over a period, dividing neatly into operating, investment, and financing activities. On paper but still run out of cash, this statement reveals a raw operational truth. Types of financial analysis. These are three primary methodologies we use to dissect these statements and look past the raw numbers. Horizontal analysis compares the financial data over a sequential period of time, typically trailing across 3 to 5 years. It is used to identify the historical growth trends, compound growth rates, and helping you answer questions like vertical analysis. Look at a financial statements internally by showing each line item as a percentage of a single base figure. For example, on the income statement, we look at every single item as percentage of a revenue. On the balance sheet, we benchmark every item as a percentage of total asset to see how capital is distributed. Finally, ratio analysis use mathematically relationship between the different accounts to evaluate and compare performance, liquidity, solvency, and profitability against the competitors or in the industry benchmarks. The industry distributors against a massive blue chip market leader. Liquidity ratios. Let's move in the specific ratio category, beginning with liquidity ratio. This measures a company's immediate survival capacity, its ability to meet its short-term obligation and the pace of current debts with running into a catastrophic cash charge of insolvency. The current ratio is calculated as a grade general guide. A result greater than 1 is considered the absolute bare minimum, while a ratio around 1.5 Short-term assets like inventory and receivables to cover never near-term bills. Only on highly liquid assets. It is intentionally stripes out inventory because inventory can take months to liquidate in a sudden economic downturn. The formula is an acid test score greater than 1 indicates a very strong, highly secure short-term liquidity position. Finally, the most conservative metric is the cash ratio calculated by dividing cash and cash equity by current liability. A company can pay its immediate liabilities tomorrow morning using nothing but the raw cash sitting directly in its bank account. Solvency ratios. While liquidity is about surviving the next 12 months, solvency or leverage ratios measure a company's long-term financial stability, structural safety, and long-term capital allocation choices. First is the debt-to-equity ratio. Generally, a lower ratio is safer, showing that the company relies more on permanent owners' capital than on outside debt. If this ratio is too high, it means the company is heavily leveraged, leaving it vulnerable to rising interest rates or sudden revenue drops. Second is the debt to assets ratio. A lower number here is excellent because it indicates less overall dependence on debt to fund the company's asset base. It tells you exactly what percentage of the company's assets are owned by lenders versus shareholders. Third is the interest coverage ratio. This is a critical safety margin metric. It measures how many times over a company can pay its annual interest obligation using its earning before interest and taxes. A higher multiple indicates a much better operational ability to sustain its debt obligations. Profitability ratios. Now let's examine profitability ratios with a measure a company's fundamental ability to generate wealth relative to its sales assets or equity base. The gross profit margin is calculated as a high percentage indicates a excellent pricing power and strong manufacturing or direct cost efficiency before overhead are factored in. The net profit margin takes the final bottom line into account. Higher margin here points directly to outstanding overall corporate profitability and tight control over profiting expenses, financing cost, and taxes. Next, we look at return on assets or ROA. ROA shows assets intensity. It tells you how many cents of profit management extract from every dollar invested in physical and non-physical asset infrastructure. Finally, returns on equity or ROE focus squarely on the business owner. This is ultimate metric for public equity investors, indicating the rate of returns management is generating on the accumulated capital pooled together by the shareholders. Activity efficiency ratios. Activity or efficiency ratio shows us operational velocity, how fast and efficiently management utilize the company's asset to drive sales results. First is the inventory turnover ratio. A high turnover number indicates highly efficient inventory management, excellent demanding matching, and faster sales cycle, preventing cash from getting locked up in rotting or absolute warehouse stock. Second is the receivable turnover ratio. A higher number here shows strong collection efficiency, a disciplined credit policy, and proof that customers are paying their bills on time rather than lending cash stacks as uncollected debt. Third is the overall asset turnover ratio calculated as revenue divided by total asset. This tracks a company's raw operational weight. It tells you how many dollars of top line revenue are generated by every single dollar of asset on the balance sheet. DuPont analysis. To conclude our analysis framework, let's look at the ultimate diagnosis tool, DuPont analysis. DuPont analysis breaks down return on equity into three distinct components, so we look under the hood and see exactly what's driving the company's financial performance. DuPont framework breaks it down into these three core relationships by expanding these terms into three their raw chemical formulas by operation. This reveals the real turn behind management strategies ROE in three completely different ways: by maintaining high profitability margin, by turning over its asset incredibly fast, or by taking on aggressive financial leverage. Use to see if a company is a genuinely operational compounding champion, or is it simply masking weak margin and slow sales by taking on risk debts. Let's open up the floor to any questions about this financial relationship. This is the end of this video. We had studied to analyze reports, documents and ratios. Thank you for watching. Stay tuned for next video on Saturday 6:30 p.m. Bye.